we are covering settlement options for the national portion of the life insurance exam. When an insured individual passes away, the death benefit must be distributed to the beneficiary. The most straightforward method is the lump sum, where the entire face amount is paid out at once. This is critical for the exam because the lump sum is the default option. If the policy owner did not select a specific settlement option prior to their death, the insurance company will automatically pay the proceeds as a lump sum. From a tax perspective, remember that the death benefit itself is generally received income tax-free, but any interest earned after the death is taxable. Next, we look at the interest-only option. In this scenario, the insurance company retains the principal death benefit and pays only the interest earned to the beneficiary at regular intervals. This is often used when the beneficiary wants to preserve the principal for a later date or for a secondary beneficiary. On the exam, you might see a question asking which option allows the beneficiary to eventually receive the full principal while receiving periodic payments in the meantime. That is the interest-only option. A major trap to watch out for is the taxation. Since the payments are strictly interest, the entire amount received by the beneficiary is taxable as ordinary income. The fixed period and fixed amount options are frequently tested together to see if you can distinguish between them. The fixed period option, also known as period certain, guarantees that the death benefit and interest will be paid out over a specific number of years. For example, if a beneficiary needs income for 20 years, the insurer calculates the payment size based on that time frame. Here, the time is the constant and the dollar amount is the variable. Conversely, the fixed amount option sets a specific dollar payment, such as $2,000 per month. The payments continue until the principal and interest are completely exhausted. In this case, the dollar amount is the constant and the time is the variable. A common trick question will ask which option guarantees payments for a specific length of time. The answer is fixed period. The life income option functions like an annuity and is designed to ensure the beneficiary never outlives their money. The insurer calculates the payment based on the beneficiary's life expectancy, which involves their age and gender at the time of the insured's death. There are several variations you should know for the exam. The straight life option provides the highest monthly payment because it stops immediately upon the beneficiary's death. The life income with period certain guarantees payments for the beneficiary's life, but also promises to pay a secondary beneficiary for a minimum number of years if the primary beneficiary dies early. When discussing the life income with period certain, the exam often tests what happens if the beneficiary outlives the certain period. If the period is 10 years and the beneficiary lives for 30 years, the insurance company must continue to pay for all 30 years. The certain period is only a minimum guarantee for a secondary beneficiary, not a maximum for the primary. To help you remember these options, use the mnemonic phrase lion's interest fixed forever. L stands for lump sum, I stands for interest only, F stands for fixed period, F stands for fixed amount, E stands for every month for life or life income. When taking your exam, pay close attention to who is making the choice. If the policy owner selects a settlement option during their lifetime, that choice is usually binding, and the beneficiary cannot change it after the owner dies. However, if the owner made no choice, the beneficiary can select whichever option best fits their needs. Also, look for the Spendthrift Clause in questions about settlement options. This clause protects the policy proceeds from the beneficiary's creditors and prevents the beneficiary from spending the money too quickly or assigning it to someone else. Always distinguish between the principal, which is tax-free, and the interest, which is taxable.